Everyone, welcome back. Today we're going to talk about a loan for all you property investors out there, DSCR loans. Some of you may have never heard of DSCR loans before, or you've heard of them but aren't quite sure how they work. Well, DSCR stands for Debt Service Coverage Ratio. Now, I know that might sound a little technical, but it's actually pretty simple. It's a way for lenders to measure whether the income from a rental property can cover the debt payments on that property. It's about the property's performance, not your personal finances. So traditional loans look at your income, your pay stubs, W-2s, tax returns, and all that. DSCR loans, not so much. They don't care about your personal income or employment history. What matters is whether the property itself generates enough cash flow to cover the mortgage payments. If it does, that's what gets you in the door. DSCR loans typically have slightly higher interest rates than traditional mortgages, though. It's the trade-off for more flexible qualifying criteria. All right, so who qualifies for DSCR loans? The short answer is real estate investors. These loans aren't for primary residences or vacation homes you plan to use yourself. They're strictly for properties you plan to rent out, whether it's a long-term rental or short-term vacation rental like an Airbnb. And if you're a first-time investor, that's okay. Now, the beauty of DSCR loans is that it's all about the property's income potential. You can qualify if the property generates or is projected to generate enough rental income to meet the lender's guidelines. That's a huge plus for people who might have complicated personal finances or want to avoid the hassle of verifying income with a traditional loan. Now, I did a loan for a woman once who owned her own fairly large business, and she owns several properties. Now, even though she could qualify going the conventional route, it just wasn't worth it for her to have to supply so many documents she had on her business, plus all the documents for the other properties she owned. She wanted something quick and simple, so this was the way to go for her. So let's talk about property types. DSCR loans are pretty flexible. They can be used for single-family homes, condos, townhouses, 2 to 4 units. Some lenders allow for multifamily properties with 5 or more units. And as I mentioned, short-term rentals like Airbnb or long-term rentals, and in some cases even mixed-use properties. And this loan can be for purchases, rate and term refinance, or cash out refinances. So basically, if the property is an investment and you're planning to rent it out, a DSCR loan could be the way to go. All right, now what's great is that there's no limit on how many properties you can finance with DSCR loans. So if you're planning to grow your portfolio, this could be a strong financing option since going a conventional route, typically you can only have up to 10 properties financed. Now, getting into the nitty-gritty of what you'll need to actually qualify for one of these loans, most lenders will require a down payment of at least 20 to 25%. Some lenders might offer a higher leverage, like 15% down payment option, but that often comes with stricter terms, maybe a higher interest rate or more reserves. 20 to 25% is standard for investment properties in general, but 15% is an option with the DSCR loans. So the property's cash flow is the focus, and they just want to know that you have skin in the game from the start. All right, so let's say you're looking at a $400,000 loan on a rental property. You'll need to expect at least $80,000 to $100,000 upfront for the down payment. You'll also need a decent credit score. For most DSCR loans, a minimum credit score of 640 to 680 is required. But the better your credit, the better terms you're likely to get. That's just how it goes with any loan. If your credit score is above 700, you're in a much stronger position to get more favorable terms than if it's below 700. Other requirements are cash reserves. Most lenders will want to see if you that you have anywhere from 3 to 12 months worth of mortgage payments set aside. This is just a safety net to ensure that if something goes wrong, like you have vacancies or unexpected expenses, you can still make the loan payments. All right, now this is probably the most important part of understanding DSCR loans, calculating your debt service coverage ratio. This is the key number that tells lenders whether your property generates enough income to cover the loan payments. Now, here's how you calculate it. Your DSCR score equals your gross rental income or potential rental income determined by an appraisal divided by PITIA, which is principal, interest, taxes, insurance, and homeowners association dues. So let's say your property brings in $3,500 per month in income, and let's say your principal and interest payment is $2,100 per month. Your taxes are $300 per month, and your insurance is $125 per month, and let's say you don't have any homeowners association dues. Your total monthly expenses for the home is $2,525. Now, if you take your $3,000 divided by the $2,525, your score is 1.39. That's your DSCR score. Lenders love to see a score of 1.25 and above, but even over 1.0 is looking good. This shows them that the property isn't just breaking even, it's actually generating extra income. Now, if your DSCR score is below 1, it means the property isn't covering the mortgage, and the lenders see that as a red flag. There are lenders, though, who will lend with a DSCR score of less than 1.0, but in those cases, they usually require a larger down payment to offset the risk, and you will have a higher interest rate. There are interest-only loan options, though, if you want to see a little bit more cash flow come through your property. Now, something that DSCR loans do tend to have is a prepayment penalty. This is a fee that some lenders charge if you pay off the loan early, either by selling the property or refinancing. So typically, prepayment penalties last for the first 3 to 5 years of the loan. The investors have loaned you money based on the expectation of making a certain amount in interest over time. Now, if you pay off the loan early, they don't get all that interest, so they charge you a penalty to make up for it. Now, if you're planning on holding on to the property for a while and not looking to refinance or sell, opting for the highest prepayment penalty will give you the best rates. The lender might have a straight prepayment penalty, meaning if there's a 5-year prepay, if you sell or refinance anytime within that 5 years, you'll pay a flat 5% fee. Another prepayment penalty option is with points, or also known as a declining option. If you have, let's say, a 3-year prepayment penalty with points, then you will have to pay 3% of the loan balance as a penalty if you sell or refinance within the first year. 2% if you sell or refinance in the second year, and then you'll just have a 1% prepayment penalty if you sell or refinance in the third year. Now, your loan officer will go over options with you and see what would be the best for you depending on how long you plan on staying in the loan. Okay, another bonus with DSCR loans is there are some lenders that will allow for vesting in an LLC or an S Corp or a C Corp, so you don't have to vest necessarily in your personal name or trust. So basically, there's ups and downs with DSCR loans. Yes, you're going to have your higher interest rates, prepayment penalty, larger down payment, but you don't have to worry about your income determining if you qualify or not. And this is a great option for starting or expanding your investment portfolio, whether or when you're not tied down to the specific guidelines that a conventional loan will have. And for those of you who just want to invest in a property. Now, if you've got any questions, please feel free to give me a call or drop them in the comments. I'm happy to work with you to see if a DSCR loan is the right way to go. And don't forget to give a thumbs up and share and subscribe. So thanks so much for watching. I'll see you next week.